Hi, good afternoon, and thank you very much indeed. It's been a long afternoon, and thank you very much for staying and being part of this last session of the day. My name is Ed Higenbottam. I'm the MD of Verdant Capital, which is the manager of the Verdant Capital Hybrid Fund. I'm very, very lucky to be hosting today this panel on innovative credit to MSMEs. We have three very interesting businesses here, which have different and newer business models in terms of extending credit to people who are using that credit productively in their own lives and in their businesses. I'm joined by Rafiq Suleman, who is CFO of Watu Credit Uganda. Watu Credit is an innovative financier of motorcycles, financing them for entrepreneurs who are predominantly taxi drivers. I'm also joined by Manuela Böck, who is CFO of Altech. Altech is financing solar solutions to small businesses and individuals all across the DRC. And finally, I'm joined by Geoffrey, who is the Regional CEO East Africa for Flow Global. And Flow Global is a business which is supplying small cash loans to merchants in Uganda, in Rwanda, and expanding into new markets. With that, I'm going to hand you over to Rafiq, who's going to tell you a little bit more about his firm, why his business was set up and the problems it's solving, and about his core products. Thank you, Rafiq.
Thanks. Thank you, Ed. Hello, everyone. So I'm Rafiq Suleman. I'm the CFO of Watu Credit in Uganda. So as Ed mentioned, Watu Credit is a non-deposit taking microfinance institution with, as a group with operations across 7 countries in Africa. I'm the CFO in Uganda. So Watu started operations in 2015 to create a solution for the challenges faced by Africans in assessing affordable and flexible financing. So Watu, it's one of the fastest growing asset finance companies and headquartered in Mombasa, Kenya. So I'm the CFO, so I like to talk about numbers. As a group, country, Africa-wide, there's over 3,000 employees at Watu. And to date, Watu has dispersed over 400,000 loans, asset finance loans. So Watu expanded to Uganda in 2019, second market for Watu in Africa. So Watu's focused on secured lending, as I mentioned, of two-wheeler motorcycles to borrowers who are typically boda, motorcycle taxi operators. So very micro scale in terms of entrepreneurship. So in Uganda, we currently have over 55,000 active loans, and that's a portfolio value of over $50 million. Each bike is around $1,300 US at the moment. We have 18 branches countrywide. So the problem that Watu, intended to resolve is that, like most other microfinance institutions, loans were provided by traditional microfinance or financial institutions with very stringent measures. So it's very difficult to access finance and, very bureaucratic and just very difficult. And, if there was no financial history, very tough to get finance. So for these lower value assets, such as motorcycles, the clients would predominantly be renting informally. So they have no pathway to economic ownership. They're not building any sort of financial history. They also don't have any economic independence. So the motorcycle could be taken away from them at any given time, or could face mechanical issues, which were, sometimes out of their control. And then on top of this, payments are generally cash. So there's just no record of this. And while they're able to earn money from renting the asset, they weren't getting the full economic reams of what they could in terms of reaching the potential. So then on top of this, like I mentioned, no emphasis on mechanical condition or road safety. So they could be driving very old motorcycles, which is dangerous, and not receiving any sort of road safety training, not required to have any sort of formal permits. So Watu is trying to change that and formalize this industry, which is very much, as I mentioned, a very informal industry. So Watu leverages speed and technology to provide an improving experience for our customers. So we really put the customers first, and that's how we differentiate ourselves. So we issue motorbike loans in really 2 hours or sometimes less, And that allows the borrowers to immediately start generating income from the asset and, fulfill their dreams of becoming entrepreneurs. So, you do have to come with a down payment of, a minimum of $200. So to get this down payment is difficult. And borrowers, once they are able to raise those funds, they want the asset right away. So we issue the loans almost immediately when they're there in the branch, and there's no bureaucracy in terms of going out into the field, doing enhanced credit checks, enhanced reference checks, and things which can open up the doors for I think slow speed of service and other potential things such as fraud or et cetera. So Watu, gives full transparency in the loan issuance process and adequate customer support as well throughout the loan duration. So no bureaucracy is up front and throughout the whole loan process, very flexible with the borrower. So further on that point, Watu uses alternative methods of assessing portfolio quality and client repayment performance. So, we're not looking just at PAR 30 as our metric of, the client's performance. We're really looking at, is the client making a willingness to pay? Is he responsive when we reach out to him via phone? And just much more closer touch with the customer and using technology as well in this process. So we like to say we're building a mobility ecosystem that drives financial inclusion to the unbanked and underserved while promoting digital payments, financial literacy, and increasing regulatory and safety compliances. That's what to.
So my name is Manuela. Yeah. I'm the CFO of Altech Group, which is a Congolese DRC-based energy access company. We mainly distribute solar products. So the company was founded in 2013 by two Congolese who were born in Baraka, which is in eastern Congo, a city of 100,000 people, completely off-grid. So then in the 1990s, when the civil war broke out, Yongwa and Washikala, who are the co-founders, had to flee to Tanzania for safety and spend another 10 years completely off-grid. Luckily, at the refugee camp, someone spotted their talent, and they won scholarships to study at the University of Dar es Salaam. And having gone through the hardship of being grown up off-grid, they really had a strong desire to go back to their country and contribute to the development of the DRC. So once they learned about the challenges or the point of electrification in the DRC, they knew that developing a company in the off-grid energy space is what they wanted to do. So having started very small in the city of 100,000 people, over the last 10 years, the company has expanded across the DRC. We are in operation in 22 out of 26 provinces. So again, the DRC is 5 times the size of France, or like Western Europe. Very big country. We have 120 shops operational across the DRC. By January 2023, it will be 160. We have built a team of 3,000, getting close to 4,000 Congolese now. So these solutions are really like owned and distributed by the people who know the market, they know the challenges and what to do. And over the last 10 years, we distributed 300,000 solar products, which means that we positively impacted the lives of 1.5 million Congolese. Because again, at this date, 70 million people in the DRC live without basic access to clean electricity. Most of them still rely on cheap kerosene lamps. And at the same time, again, DRC has 90 million people. The national state utility counts 500,000 connections. So there's no way that the remaining population can be reached in considerable time with on-grid solutions. So how did we manage to achieve what we achieved? It's based on 5 key principles, and those are best product offerings, best customer service, healthiest portfolio, highest revenue, and highest profit margins. And what do we mean by that? So in terms of best product offering, we want to give customers a grid-like experience. So in the early stages of the sector, a mistake that was often made is that providers of off-grid energy solutions assumed, okay, this person is used to a kerosene lamp. So they consider what they are offering in comparison to a kerosene lamp, which really shouldn't be the standard, right? Because people deserve the same right of or access to electricity that we enjoy. So what we are doing is that we only offer products of the highest quality. We give tailored configuration and with the longest working hours. And by working hours, again, we mean because it's solar powered, right? So we oversize the solar panels and we oversize the batteries. So if you go and visit one of our customers and say like, how long can you use it? What are the working hours? They will actually say like, what are you talking about? We just use it as long as we want it, right? This means they can watch TV, they can read until they want to go to bed, rather than after 3 hours, the battery runs out and they're sitting again in the dark. And with tailored configurations, so we sell solar lanterns, which is an entry-level solution for a credit period of 2 months. Contract value is $63. But again, this is very popular across the DRC, whether it is in urban cities where people use it during power cuts, or then really in rural for lower income families. Up to solar home systems, so these are larger sets that can light up an entire house. Come with 6 light bulbs, appliances such as TV, fan, hair clipper, radio, torches. Second is best customer service. So we have, as I said, multiple contact points. We do have the 120 sales shops where customers can go to if they have an issue. We have a customer service center, which also has a call center. Our operators cover all of the major languages spoken in the DRC, so we can make sure that if the customer has a problem and he calls, we really speak a language they are comfortable with to be able to understand their problems. At the same time, we resolve customer problems within 24 hours to make sure that they are happy, and we guarantee free product lifetime repair. So even after the customer paid off their system, they can come back to us, and we will repair it for free. Then in terms of healthiest portfolio, again, selling on credit means you have to select your customers carefully, because you need to not only look out on who can afford it, but who is also willing to pay. So we do follow a very stringent customer selection process that starts with a basic credit check, where we go over the phone with the customer, like talking about what is their income, what are their expenses, so for example, school fees, I don't know, other basic requirements they want, and then what is left of that has to be above a certain percentage than what they would pay on a monthly basis to Altech. But then, of course, we also realize that people can tell different things on the phone than what is the reality. So following this process, we do what we call a customer investigation. As part of that, an Altech member goes and visits the customer, he speaks to the neighbors. It's a very easy way to find out what is the person's reputation. Because you go there, you knock on the door, and the neighbor will say, no, you are crazy selling to this person. There are like 5 times a day people coming, knocking on the door, asking to be paid. And at the same time, we also speak to either then the village chief, or in cities it's called chief de avenue, so street chief, who then again vouches also for the customer. And then at the end, the customer, this like village chief, plus Altech sign the sales contract, and that again makes it also quite easy to like repossess in case the customer doesn't pay. But again, then it is also on us to really build a trust relationship with the customer and ensuring a customer is happy. Because we also believe you cannot expect someone to pay for a service if the service is not good, right? Like it's the same for us. Like if I pay for something and then at the end of the month the person knocks on my door, but half of the time it wasn't working well, like I wouldn't be very happy to pay. So that's again where it comes down to what we said with like best product offering, best customer service, because these people that we are serving, they have limited incomes, and the income they have is competing against different needs. So at the end of the day, you want to make sure this customer is very happy so that they put it on top of their priority list when it comes to payments. And then in terms of highest revenue, so we achieved that through our diverse product portfolio. We have a solution for every household level in the DRC across every income level, as I said, with the entry-level solar lantern solution up to the higher-end solutions. And then we also offer additional services. So for example, now we started to sell clean cookstoves as well. We entered e-mobility, and we're looking at more solutions to add. And then lastly, highest profit margins. Our goal is to build a self-sustaining company that can lead DRC's green economy. Again, this company is really driven by Congolese. They have a desire to build something that is like independent and last, that creates a stable source of economy, stable source of income. And for that, we have high gross margins of 60%. We only grew the company in line with sales, so that we are like holding back on this. And yeah, so far we achieved it. Again, I do think it's like profitability is very important. We are not Amazon, who started out in the US. We don't have the luxury to be loss-making for 10 years. Like the DRC is already a challenging market. What we do requires a lot of financing on our end, like what we do or I do. You have to go out and fundraise with all the challenges that are already present in the DRC. If you then cannot prove that your company is inherently profitable and well-functioning, you will not have any luck raising funds, which again means that we cannot solve this problem of providing energy access to all Congolese.
Yeah, so thank you, everyone. I'm called Geoffrey Taban. I am the regional CEO for Flow Global. Flow Global is headquartered in the UK with operations in Rwanda and Uganda. So Flow has set out to level the playing field for small businesses in emerging markets. And the way we do this is by providing instant access to working capital for merchants in emerging markets, right? So when you think of a merchant, I want you to, let's paint a picture together. Who is our customer? Who is the merchant? So usually it will be a small shop at the corner, probably a mom and pop shop. They will be selling certain products, soap, soda, sugar, cooking oil, whatever. In most cases, they are also agents for financial services. So they will be doing mobile money, they will be doing agency banking, and also agents for other financial services. So in many of the cases, you find that there are different business lines within the same shop, right? All competing for the limited capital that they have. Now, on a continuous basis, the shop owner is having a challenge of how to allocate the limited resources that they have. Do I put it in mobile money? Do I sell soap? Do I sell sugar? Now, what that means is that at the end of the day, they're not going to reach their full potential because they have limited working capital, and they're not able to serve the needs of the community. And they have very many customers. Like I said, they're usually small shops in the neighborhoods. They have customers. They sell 80% of all the products, and also do financial services, right? Now, what problem does that sort of create, right? And how then do we come into the picture? Now, despite the fact that this small shop has a very focal role in the community, they're selling all the goods, doing all the financial services, cash in, cash out, they are considered risky or small by the traditional financial institutions because maybe they do not have collateral, or they're just viewed as very small, okay? So then they're left out. They do not have access to growth financing, which limits their growth. Now, on the other hand, there's a lot of transformation happening, right? Most of these businesses are informal, but more and more we see a lot of digitization happening around payments, inventory management, e-commerce. And that, I think, is very good because then it gives us the opportunity to see these businesses that initially no one was seeing. Because then there's a lot of data that is being built up, which Flow comes in and uses to sort of create innovative solutions for these businesses. So our solution, like I said, is instant access to working capital for these small businesses. And what we do is sort of combine aspects of technology and traditional microfinance. So in Uganda and Rwanda, for example, our business model is a hybrid. So yes, we're a tech company, but also we're a microfinance. So we use data. Our decisioning is based on data. So we look at data of this small shop. We look at the shop as an entire business, despite the fact that they have different activities happening within the shop. We understand their cash needs, their financing needs, and also gauge their potential for growth. Now, based on this data, based on this visibility that we have, we then customize products specifically for different ecosystems. So it could be a mobile money network, it could be an e-commerce platform. We come up with products that are specifically designed for these ecosystems. And what do I mean by that? We do not have one product, one blanket product for all our customers. We have products based on ecosystems because we do realize that different ecosystems have different characteristics and they have different needs. So we come up with different products for different ecosystems. And like I mentioned earlier on, and I think one of my colleagues here mentioned, it's very important to make use of some of the great learnings from the microfinance side of financing. So we have field people on ground that we call relationship managers that manage the whole process from identifying the customer, KYC to onboarding them all the way up to when they receive the actual credit. Sorry. So when you look at our platform, the Flow Liquidity Engine, it has three aspects really. So on the back end, of course, we have the back end user interface, which is used for KYC, data analytics, payments, product management. But we also have an element that does field force management. So the field officers that I talked about earlier on, that are responsible, one, for identifying customers, have an app that they use, which is a tool they use to facilitate their activities in the field. And on this app, they're able to, one, get a credit score for a customer, right, by just uploading the data into the app. They are able to then do a KYC for that particular customer so that we know exactly who we are lending to, and able to get all the necessary consent, for example, data consent, to use their data, and also to draw agreements between Flow and the customer. So everything happens within the app, right? And this happens in person. So for every customer that we onboard, a field officer actually goes there, talks to the customer, explains the product, explains how it can help them grow, because we present ourselves to the customers as growth partners, right? And that is very evident also in some other aspects of the business, for example, our products. Our products are growth financing, right? So, for example, we start at about $150, but it could go up to $1,200, $1,300. So actual financing that they need, and that can actually have an impact on growing their business. So the customer is able to access, after onboarding, the customer is able to access this growth financing through the customer app that we train them on. So they can go into their smartphone and request for a loan for their business. For those that do not have smartphones, they're able to also call a toll-free number and talk to someone and say, hey, I'm called Geoffrey, and I've been registered and I need a loan for my business of this amount, okay? Now, to date, I mean, in Uganda and Rwanda, we have disbursed over 30 million US dollars, of which we have recovered 99.74% back. So again, that is a reflection of how important it is to sort of use the high tech, but also the high touch, because that has been one of the major reasons why we're able to keep a very good portfolio, because we maintain a relationship and keep a relationship between us and the customer. So they value this partnership that we have because they see us as partners in their business and see us as someone who is actually looking towards their business growing. So we are live in several major ecosystems in East Africa. The unit economics are also very good. The average revenue per customer is about $245 per year. Customer acquisition cost is $7. And as of, for example, in October, again, this is a reflection of our portfolio quality and why it's important to maintain a good relationship. We disbursed 11,981 loans worth 3.24 million, of which only 32 were not repaid on time, right? So we are regulated by the central banks. For example, in Rwanda, we have a non-deposit taking financial institution license, and in Uganda, we are regulated as a money lender. We continue to grow at about 15 to 20% every month. Again, this is just sort of a monthly cohort analysis for our PAR 30 and 90. You can see that continuously it's at a very small percentage there, less than 0.5% every month. And that shows how we have grown over the last few months in terms of how much we have disbursed, and also it shows a clear picture of how we're able to manage, our overdues and make sure that we have a very good portfolio quality. The slide's a bit messed up, you'll excuse me. But in addition to making very good returns on our unit economics, we also have very good social returns. So for every dollar we have invested in our portfolio, the customer is able to generate $4 worth of revenue, right? And this is a very deliberate thing that we sort of wove into our product design. When we are coming up with the pricing, and pricing is usually an issue when it comes to credit, especially digital credit, we sort of looked at, it's sort of like a reversed revenue share. And what do I mean by that? We look at, for example, how much does a customer make with, say, 1 million Uganda shillings, okay, in a certain period of time, say 1 week. And you'll find that maybe they make 120,000, for example. So usually our fee will be designed so that the fee is 1/5 of the marginal profit that they make. And why is that important? That is very important because we want them to grow, but we want them to be a continuous customer. Because if you give them a very expensive product, they will use it once and probably not use it again. So we ensure that they make much more money from using our float advances. On average, we see our customers increase their mobile money commissions, right, to more than 45%, right? So I was talking of our small merchant will look something like this. This shop sells phones, phone accessories, padlocks, but also they have financial services, so mobile money, they have, other payments. So usually there is a constant competition for working capital between these different lines, right? So we focus on the digital aspects of their business, which usually is mobile money or agency banking, and we use that data to then come up with products that are specific to their needs. Thank you.
Thank you, Geoffrey. You have the credit collection scores that make other MFIs cry. A few questions from myself, maybe starting with you, Rafiq. Very exciting product, has so many, what I describe as self-reinforcing credit pillars. But I'm sure it's not as easy as it might seem. And what were the key challenges getting your product going in Uganda, and how does that contrast potentially with other markets?
Yeah, no, it's a good question. Thanks, Ed. Funny enough, I think the problems that we had when we first started were, almost inherently a nature of our innovative business model. So as I mentioned, we disperse asset financing loans within 2 hours, which is not common in the market. It's actually very different to other providers of asset financing in Uganda. So that almost, actors popped up in the market, that were acting as maybe agents for clients. Our clients some of them are not literate and they're very informal. So when we started, agents would come and charge our clients fees that were not, from Watu, which was, a major issue. So it was really about sensitizing clients, not only new clients, but existing clients, our business model. In addition to that, I mentioned the way we look at repayment and defaults is, I think, very different than other microfinance institutions. So we're looking at repayment scores, 14-day scores, 28-day scores, to see how much is a client paying versus how much he's scheduled or expected to pay. So even if he's in arrears for say 20 or 30 days, as long as he's making repayments on his loan and he's showing a willingness to pay, we don't consider that a default. So inherently that caused some issues internally with even staff and outside with collections agencies that were pretending to act on our behalf and collect money from clients, as well as employees at the beginning where they saw a client was heavily in arrears and they would go to the client saying you're in a default position, which was not correct. So there was a lot of sensitization of internally with our staff and externally as well with the client to make sure they understood how Watu works, how clients are assessed, both at initial loan disbursement phase and also throughout the loan cycle, the loan process. So it was very intense for that first kind of 6-12 months in sensitizing and training of clients and staff. And lastly, in addition to that, in Uganda at least, there's been quite a few institutions that would come and take deposits or down payments from clients and run away with that money. So trust, I think, whenever we open a new branch in the country, it's really getting that trust and doing those sensitizations in media, in the field, with motorcycle taxi associations, with different stages where these motorcycle taxis operate from, and it's a very hands-on and intense type process of sensitizing clients and staff. Those were the main challenges, just due to the innovative nature, I think, of our business model.
And Manuela, how does that sort of compare and contrast to your experience in launching your product in Congo?
Similar to the DRC. I mean, a key enabler of us selling a lot is obviously mobile money coverage. So for the larger system, every customer pays via mobile money. In the DRC, you have mainly M-Pesa and Orange. It has increased, like mobile coverage now over the last years has increased a lot. Like in 2013, it was only 17%, which is close to nothing. But still, there are large parts of the DRC where you have absolutely no mobile coverage. So this is one key challenge to overcome. We do offer in certain areas that the customer, for example, pays in cash to one of our agents, of course, then we also put measures in place to make sure that this cash arrives, like at our office. That is one challenge. The other one is, as I said, like DRC is a huge country. At the same time, five times the size of France, but according to a study, it has less tarmac roads than London, right? So it's extremely challenging for us to move the products across the country, and it's also super expensive, which again, unfortunately, increases the price for the consumer. So for example, we get our products from Shenzhen area in China, and it costs like 3 times as much money for us to ship one solar home system from southern DRC to central DRC than it costs for the entire route from China to the port of Dar es Salaam. And that's again because there are no roads, like really no roads. You could maybe try during dry season to take the roads. If you try to take it during rainy season, the truck gets stuck and it takes up to 6 months. So kind of, obviously there's poor infrastructure. Again, we can't build the road. So what we did is we just set up all these different entry points in the country, strategic warehouses, so that we have to, as minimally as possible, ship products via air and can then use road transportation, river, and these factors. But yeah, I mean, other challenges pretty relatable to Rafiq said, right? We have to be known on the ground for being a trustworthy company, being able to sell to the customer what we stand for, have multiple contact points.
Manuela, to what extent do you think there's a sort of virtuous feedback loop here? Because if I was a mobile phone company, I wouldn't want to put tower capacity where true. People can't charge their phones anyway.
Yeah,
right?
so what we did a bit, I mean, yeah, that I do think increased. But again, for example, what we did with customers who are now purchasing a solar home system, but they don't have a mobile money account yet. So we work together with M-Pesa and Orange Money. So for example, next to our office or our sales shop, there's now a Vodacom shop where the customer can go buy a SIM card, they will show them how mobile money works, and then like right from the M-Pesa shop, he will go to our like Altech shop to purchase the products. So we do try to work closely with the operators. Again, I would hope that they very quickly expand it even more to like leverage those effects.
So microfinance will credit businesses, and what makes a good credit business for a bad credit business very often is the quality of the credit portfolio. What's very confusing, I think, to many investors and many other market participants is different businesses have different measures of their own credit portfolio quality. And as we look at some of these newer business models that started over the last 10 years, that's also created additional sort of variations in terms of what is the right credit framework to look at a credit portfolio. And Geoffrey, maybe you can start and just what is your key credit metric that you look at internally?
Yeah, so maybe before I actually answer that, so like I had already mentioned, we try as much as possible along all the steps of our journey to ensure that we mitigate risk, right? And this is not, when you talk about portfolio quality, you don't just look at this when the customer has maybe defaulted, then you start acting on it. We try to put this at the back of our minds from the very beginning of the whole journey. So for example, starting from our products are designed in such a way that they fulfill the needs of the business, right? So rather than just put one product for every ecosystem, every kind of business, we design the product so that it's specifically designed for that ecosystem. And it might look like something very small, but it plays a very big role. Because then if you have the right product, that sort of fills the right gap and it's the right solution for the business, then there's a high chance that it benefits the business. Now, if it benefits the business, that means you're going to have a happy customer who is always going to pay you back. So that's one thing, before even you identify the customer. Two, all our decisioning is done based on data. So we do a lot of data analytics on customer data to understand the business, right? Before we can say this customer is eligible or not for our product that we have designed, right? So the decisioning is 100% initially on data. So that is the quantitative things, the quantitative side of sort of the credit analysis, right? On top of that, there are things that you will not see in the data, right? And that is why we have a hybrid model that also has not only high tech, but also the high touch. So like I mentioned earlier on, we have field staff, relationship managers. One of their roles is to do an evaluation, which is now the qualitative check to sort of complement the analysis we have done on the data. So they go to the shop, talk to the customer, talk to the other shops around the community, try to do a background check, look at the location, look at the type of business, what other activities are happening in that business. And we look at the entire business, not just maybe the mobile money business or mobile money data that we have looked at. And I think that is another thing that makes us very different, looking at the shop as an entire business, even though we are financing just one aspect of it, because then it gives you a clearer picture of what other needs they have as a business, right? So this qualitative check is also very important because in some cases, based on the data that we analyze, a customer might be eligible, but based on the qualitative check, they are not eligible, right? So that helps you to sort of sort out good customers from the rest of the customers, right? So we do that before even the customer gets on board. Now, once we onboard the customer based on good data and good qualitative evaluation, we try to build a relationship with this customer, right? Try to be as close as possible to them. Our app, the Field Force Management app, has machine learning that also, based on risk categorizations in the system, suggests visits, regular visits to certain customers based on their repayment. So over time, we're also using now the repayment history or the repayment pattern of that customer to understand their willingness to pay, right? Because it's one thing to be able to pay. The data says, yes, you're making a lot of money, but what is the attitude of the customer, and are they actually willing to pay you back? And one thing that we also did is how repayments are done. So rather than do auto debits or just sweep the money out of the account, we let the customer initiate the repayment. Again, that is a way for us to know who is willing to pay, because usually you will then know at that point who actually takes the initiative to pay you back and who doesn't. So I think it's a mix of several things that we look at all the way from the beginning of the process, and make sure that at every stage, at the back of our mind, we're thinking, what best can we do to make sure that, one, this customer pays us back and continues being a returning customer. And that's, I think, to date, what has really helped us have a very good repayment history.
Rafiq, in terms of your core measure, I think you touched on this in your last answer.
Yeah, no, for sure. Yeah, so at a company, at a company level, we're looking very simply at what was received, what was paid to us, in relation to what was scheduled, what was due from clients at a holistic, at a whole portfolio level. That's our most important metric internally in terms of collections and how healthy our portfolio is doing. Of course, some clients will pay less, and some clients do actually pay more than what they're scheduled to repay. So we look at it on a holistic level to see the health of the collections of the portfolio. That's at a management level. Then, of course, within the collections department, we have portfolio quality officers that are assigned 450 clients for each officer. And those officers are looking at, as I mentioned, the 14-day scores, 28-day scores, and 42-day scores. And it's following the same principle, the same notion of how much a client was scheduled to pay versus how much he's paid for the previous 14 days or 28 days. And even if he's in arrears and he's showing a current willingness to pay, that's very much positive in our view, and the client is not flagged for default. So, of course, our portfolio is not as healthy as Flo's portfolio over there. But as long as the client shows a willingness to repay and he completes his loan before the duration of the loan, which is a maximum of 24 months, he's also not charged any sort of late payment fees.
Manuela?
Yeah, similar. So the solar lanterns, the processes for us for solar lanterns, which is the entry-level solution, and solar home systems is quite different. As I said, solar lanterns, we sell them on a credit period of 2 months, and the customer makes a $3 down payment and then on average pays $1 per day. And here, again, we also sell in like high-earning urban areas where people use it during power cuts, but it's largely lower-income households that don't have mobile money, and they don't have the capacity to do financial planning. So again, for us, the importance is there, just we have to be there when the customer has money. And for that we incentivized our agents. They earn the most money when they actually pay or collect the payments from the customers. So that is one. So for solar lanterns, we have our agents who go and visit the customers on a daily basis. And next to that, we also set up activation tents. So these are across cities like Altech tents where the customer can go, bring their solar lantern, he pays, it gets activated through the Paygo software. So it's really this matter for solar lanterns, and there our collection rates are over 100%, because again, people are happy to pay, but we also need to make sure that we are there when they have money, because you could be there today and then he says oopsie, yesterday I had $5, you should have been there then. So that's for solar lanterns the key point, we just have to be there when the cash is available. And there, our portfolio at risk categorization for solar lanterns is lower, so we look at portfolio at risk 5 days late. Again, the credit period is only 60 days, right? So this risk comes at a much shorter period. So the key thing is trying to keep customers 5 days late. That's the maximum it can get to, and then the repossession process kicks in. Now for solar home systems, there the credit period goes up to 3 years. So we look at portfolio at 30 days late. Again, we do give a customer for solar home system a grace period of 30 days, because DRC is a challenging country, and we know that customers will struggle at times, and especially the last years with COVID. So they can be up to 30 days late, nothing happens. Again, we remind them that the payment is due. And then once the 30 days are over, this is when the repossession process kicks in. So like an Altech member will go visit the customers and just say like, hey, you really need to pay now, otherwise you run the risk of repossession. But then again, what we've also done is, for example, maybe a customer has been on a credit payment plan of 15 months, and then we put them on a payment plan of 30 months, which lowers the monthly installment that they have to pay to Altech. Maybe they had a system with a 40-inch TV that is, again, much more expensive than just a solar lighting solution or a smaller TV. So we try to work with the customer before we really take the measure of repossession. But then at the end, again, we also want to be known to be strict with our repossession process to make sure the customer is motivated to pay.
And what is your par 5 currently on solar lanterns, approximately?
Like days, like now for lanterns, we have an active portfolio of 25,000 customers, and there are around 5,000 customers who are late.
Okay.
But this, I mean, late paying not even beyond the 5 days.
So that's par 1?
Yeah.
Okay.
Yeah.
Thank you, Manuel. So I've got more questions. I could keep asking you questions all evening, but maybe we go to the audience next, and if there's specific questions, maybe address them to to who you want to answer the question first.
Am I audible?
Yeah. Shall we do one-on-one? One, then one.
Yeah. So you talked about the data that you use, like machine learning, to understand who is a good customer, who is a bad customer, and you also use qualitative ways to do it, right? So whenever you do use qualitative, definitely there's a lot of human resource involved, right? Which again brings the pressure on the interest rates that you charge to the customers, right? So, and then you also said that you kind of engage with them to increase their customer lifetime value, right? So when you're using these technologies and all these new age technologies, how are you also passing on the benefit to the customers so that their rate of interest goes down than the traditional ways? But once you use a lot of qualitative, that's when it is impossible to do it. So how are you managing a trade-off between, say, doing exactly the same thing which probably microfinance does or some institution does, and how, as a new age lender using technologies, how are you managing it, and how are you passing on the benefits to the customer as well, rather than just increasing the CLVs? So yeah.
I think that's for you, Geoffrey, no, to begin with?
Yeah, thank you. That's a very good question. So maybe just to answer you. So like I mentioned, we try to balance the tech and the touch, right? So we're not completely doing what the microfinance is doing, and we're not completely doing what the tech is doing. So where the tech is good, like data analysis, payments, disbursements, we use tech. And for aspects that the human touch works better, we also use the human touch. So we have relationship managers, like I told you, that we give a specific load of customers, right? So say 150 customers. They are assigned geographical territories where they work from to create efficiency. So for example, relationship manager X would be working in a place called maybe Kampala, right? And within Kampala, there are 150 customers that will be assigned to this relationship manager. So we do that to sort of be more efficient so that we don't have, every other day to keep getting the human resource to sort of increase our expenses. So we try to limit the relationship managers to specific geographies and give them a specific load that they can manage. And how does the customer benefit from our tech, right? So in addition to sort of the high touch that we're doing, we also have, for example, the customer apps that help us also to scale much faster. So using this app, the customer is able to do self-service. So for example, requesting for loans, requesting for product upgrades, feedback, and so many other tasks. They're able to do that on the customer app, right? Which makes it more efficient. They're able to get their loans within a minute, right? Which makes it much better for the customer. So I think it's the important thing is to strike the right balance, right, between the technology and the high touch to get the sweet spot, to say, which will help you, one, reap the benefits of traditional microfinance, but also give you scale very fast, right? Yeah? Okay. That answers your question?
Just wanted to also understand that, are you also, say, the good customers, are they getting benefited in terms of the rate of interest as well? That since you have been a better customer for us, there is a dynamic pricing.
Risk-based pricing.
So do you kind of, risk-based pricing or a dynamic pricing, because you have been our customer for long, you have been paying a great. So is it a standard pricing that you charge, good, bad, ugly, everyone the same, or you are just changing it?
Yes, so to clarify on that, so for our good customers, the way they benefit is two ways, right? So when we look at repayment history, willingness to pay, and then we say, okay, this is a good customer. One, they get increased amounts, right? That help them to grow their business. And also these increased amounts come cheaper, right? So by being a good customer, they get rewarded with more financing for their business, and that more financing is cheaper, right? So that is an incentive for them to continue paying us well, so that, one, they benefit more, and also pay less in terms of fees, right?
Sam, perhaps a question online.
Hi everyone, I'm Sam Mendelsohn from e-MFP. I'm looking at the online questions and Q&A. There are a couple of short ones to individual speakers. Should we do them all in one go? To Geoffrey from Jose, is poor internet access a problem you encounter in your areas of intervention in Africa?
Yes, it is a very big challenge. And that is why also, in addition to the app, which you only access through the smartphone, we provide a toll-free number that customers can just call directly to request for a loan or confirm repayment, etc. So yeah, internet in some areas is a huge challenge, and we try to sort of tackle that by giving different channels which the customer can use to communicate or request for financing.
Couple more while we're doing it. Two questions to Manuela. From Dorcas, dispersing asset loans in 2 hours is impressive. How are you doing this, and are your repayment rates good? I think we can cover that as much as you want. The second one is this asset client ownership of an asset, I think, or is the payment for leasing with a buying option at the end?
Yeah, I think the 2 hours was Rafiq. We can't do it in 2 hours. He has to tell me how he does it. Not like I would say for our market, like really discuss, like as we continue to scale, it's a question we get very often, right? Is it scalable, the sale, if you have to go to every customer and do this investigation? But it's just for us a definite yes, because we need to have the certainty around, right, is it a credible customer? And we also have to really know where do they live. So we sell PayGo, but the asset or the system belongs to Altech, the company, until the customer pays it off. So over the course of the credit period, it is Altech's, and then whether it's at the end of 15 months or 30 months, whenever the customer paid off, that's when he then owns it.
And one more, if I can. It's from Barbara Magnoni, who might be in the room, but she says this to all of you. Interested in knowing whether panelists think person-to-person contact and relationship banking influence customer fit and repayment.
Rafiq, why don't you start?
Sure. Yeah, I can quickly touch on the 2-hour question. That I think with us, it's a very standardized product. We have one product, and that's how we're able to disperse in 2 hours. It's asset-backed, so a lot of people don't consider this securitized, but for us, we do consider the motorcycle as security. And then it's very standardized in terms of the income they're generating from this asset, so that allows us to disperse the loans in a very quick period of time. On the second question, sorry, can you repeat the question?
Yeah, does person-to-person contact and relationship banking influence customer fit and repayment?
Yeah, no, for us, so it's very much not the case. So we segregate duties across almost every department, and it's very segregated in terms of collections, disbursement, and recovery. So, you know, the client will deal with multiple people depending on what stage they're at in terms of the loan. The person who onboards the client will not be the same person that's collecting from the client, or if they do get to default, not the same person who's repossessing, and we do segregate the duties by all means, and it's very much not within our business model, that personal touch, but we emphasize within the company, definitely the client comes first, and customer care is a huge emphasis internally for all staff, not on an individualized basis. Yeah.
Manuela?
Yeah, I think for us it's super important. So the company did start out by selling the solar lanterns, and as I said there, the customers paying cash to the agents, so naturally they have a very close relationship with that agents until they pay off the product. But we do have these collection rates of over 100%, right? Which means in fact the customer is paying off the system sooner than he has to. For solar home systems, the larger one, we have currently collection rates across around 85%. There again, the consumers pay in mobile money only. So these collection rates are less than the solar lanterns, and we believe a huge difference is because there isn't that close relationship with the customers. So now we are rolling out what we call portfolio agents. So one portfolio agent will manage 200 solar home system customers. Like this portfolio agent lives in the same community or neighborhood where his customer group is. And again, it's just a matter of like knowing, because again, in urban cities, the customer over a period of 3 times maybe moves up to 6 times, right? So it's for us like knowing, is the customer still there? Like, is the product working the way it should? Like, is the customer happy? We can then remind him of the benefits of paying off early, because they do get a bonus for that. But also just, to have this relationship and knowing that we are there, because I touched on it a bit earlier, but really building this trust relationship with the customer. And we do think like this cost of having someone go there in person is really offset by the much better portfolio quality and repayments.
Geoffrey?
In a nutshell, yes, it does affect. Like I already mentioned, it's very important, I think, the high-touch aspect of our business. One, to help us understand the customer, because we keep engaging the customer on a continuous basis. But two, to also give the sense of partnership between us and the customer, that we are always going to them, checking on them, asking about their other needs, their other challenges, and getting that feedback and feeding it back into our product design to make our service better. So overall, that definitely results in better performance overall.
I think back to the room. Next question. And who you'd like to answer it first?
Hi, Amelia Greenberg with SPTF, and the question is for Rafiq. We have heard one of the risks of digital finance is over-indebtedness, and when you say don't do any verification, 2 hours to disperse a loan, that triggers that response in me, and in particular what you said about it's difficult for clients to raise the 200 deposit that you require makes me wonder if they're ever raising it from like a loan shark or something, and then if their business isn't profitable and you've not done any due diligence on their ability to raise money using this motorbike, are they getting into a position of over-indebtedness? So I wonder if you've considered that risk and how you mitigate it. Thank you.
Yeah, no, I think it's a valid question, and we do receive that from potential investors as well in our business. Unfortunately, it's very much, I think, some of it is in our control as we're the ones dispersing the loan, but a lot of it is out of our control as, unfortunately, our clients are traditionally informal and unbanked, so they don't have that credit history. So we can't search within the Credit Reference Bureau to see, do they have other loans, have they defaulted? With our regulator, the Uganda Microfinance Regulatory Authority, we're constantly pushing them. Whenever we have sessions with them, we're pushing them on this, that we want to get more of the lower non-banked people on the Credit Reference Bureau system, but it's just something that's not very much in our control. And if we just ask them bluntly, do they have other loans? It's just very hard to know whether we'll get genuine feedback or not. So we're pretty much putting the trust in the client. Being a private business, we're putting the trust in the client that if they're coming to us for a loan, they're coming with genuine intentions. And because we are asset lending, we're lending them an asset, and that asset is used to generate an income. our belief is that the payments will be made since they're using that asset for productive purposes and to generate an income. So even if they do have other debts, hopefully this asset can generate an income so they can repay the loan and also have additional funds at the end of the day to whether improve their lives or pay other loans or whatever it be necessary. So we do our market research in terms of how much does a motorcycle taxi driver earn, and it's more than sufficient to cover the loan repayments and slightly higher than what they would be paying alternatively to rent a motorcycle. So that's how we kind of base our credit decisions and our underlying lending, I think, rationale. But
it's good answer.
Hello, my name is Fede Potjer. I just came back to Europe, so now I'm between jobs, but I'm not so worried yet. My question is to Manuela Böck. I start with a big size compliment in the DRC, doing something like this with the road system, the electricity problems, the mobile coverage, but you know it better, and the security situation, but you know that better than we do. My question is, in addition to all this great work that you do you measure some kind of social performance? For example, increased school results. So I can imagine carbon dioxide will be easy to measure, but what more do you measure? I'm not saying you should, because you already have your challenges, but still I'm very curious.
Now we do measure our impact on the same, we also report on impact to our investors on a quarterly basis. So one key difference for the DRC as well, because of the low electrification rate, you do find large urban areas across the country. It's like a city of 2 million people, and they're living completely off-grid. So even there, like some might be work in mines. They're like these small enterprises like bars, and the only way for them to electrify the place is through an off-grid energy solution and this Altech. So we also do have the same situation that the asset that we provide helps the customer to generate more income. So every now and then we partner with 60 Decibel, for example, who then runs a study across customers that shows that their income increased significantly on what they report. Again, we calculate based on market standard what's the avoided CO2. We look at what are the livelihood improved compared to, for solar lanterns, compared to what the customers that we sold to would have spent on kerosene lamps. We actually achieved collective consumer savings of 45 million by now. Because again, at least they purchase the solar lanterns, and then the solar lantern lasts for 5 to 7 years. So those are savings for the customers, where he doesn't need to spend his money on kerosene, but rather forgets about it for 2 days. So it is important for us. We are also a social enterprise. We are there to create a lasting impact. So we do look at lives improved, CO2 avoided, consumer savings, but also increased income. Again, we have a gender action plan, how can we create more employment opportunities for women? How can we specifically target female consumers and cover their needs?
I like the suggestion, though, about improved school results. I think that'd be a really interesting question to ask customers. I think actually, for your business model specifically, but actually to all MFIs,
I mean, we did, for example, now when schools started in the DRC, we did a specific marketing campaign targeted to parents, right? Hey, school is starting, buy the solar lantern, it will help your children to study more. Unfortunately, right now, our PAYGO platform, there isn't a question mark that specifically asks them to find it. So I can't really quantify what I'm saying, but I do think there's a huge impact. And then again, we also partner with schools, whether it's directly with the school or then through an NGO who supplies the school, but we have a lot of electrification projects across the country in schools as well.
Gentleman halfway up.
Yeah, thanks. I'm Drew Colvin with the Solar Industry Association. And my question is about the agent models. We see a lot of innovation with some companies moving towards kind of full-time salaried staff, and they invest in the training, retention, stop the churn, but of course it increased the overheads. And some are moving towards more commission-based models and trying to really reduce overhead costs and do everything based on incentives. And then again, some payments based on sales versus quality. So yeah, it's a kind of dynamic space, and I'm keen to hear what you've done, what are your lessons, and how do you get the collection rates that you do?
It's you again, man.
How did it? Yeah, I mean, we do like struggled in the past 2 years again because of COVID-19. Most of 2020 and 2021 we spent without any products to sell. So of course, like agents leave because they have to look for other opportunities. At the same time, we see like Altech is paying well. We did structure it, as I said, especially for solar lanterns in a way that the agents make most of the money when they collect the cash as well, and then we do pay bonuses. So what we see is that when we have products to sell, like we are able to retain the agents. I mean, many agents again also come back, like once they know, hey, Altech has products to sell again, they do return to us. Having said that, we are paying purely on a commission-based model to our agents. I mean, I also know that in those cases it's less than ideal for the agent, but again, we are a company in the DRC, we have our own struggles, and if you don't have any products to sell for most of the year, you need to find ways to like minimize your overhead to be actually able to like overcome these challenges and then be able to operate again once you receive the products. I don't know if that helped.
I'll take one more question, but maybe not for Manuela, but maybe for one of the other. Hannah.
From Geoffrey, we already heard about your portfolio at risk numbers, but could we get the PAR 30 numbers from Rafiq and Manuela?
Yep, so ours are definitely, as I mentioned, not as good as Geoffrey's. Our PAR 30 is closer to 20%, and yeah, PAR 60, high single digits, around 8%. Yeah.
I mean, for us, portfolio at risk 30 days late, and this is historically has always been below 3%, PAR 30 has been below 1%, and PAR 90 below 0.1%. Yeah, I mean, it's some of the best in the industry, and I think I outlined the reasons why we do think this portfolio quality is as good as it is. But
Sam, I think that's nearly all we've got time for, but maybe to wrap it up, I'll ask one question to all the panelists. Not quite a one-word answer, but nearly one-word answer. If there's one new country in Africa that you could enter, you could take your business into, one new country, which country would it be? And very simply, why? Geoffrey.
Very good question, first of all, because I was just discussing this earlier on with one of my partners. So
you only had one choice, by the way, Geoffrey. You can't have three.
Yeah,
one choice.
Yeah, people usually sort of ask, what do you put in your mind before you select to go to a country, right? For example, now we're in Uganda, and then now we're in Rwanda. So just earlier on, we were discussing like what would be the next market that we go to, and there are a couple of things that we look at when we want to go to a certain market. So one, we look at the level of digitization in merchants, because we basically depend on the data to do our credit decisioning, and also at what stage the digital financial services are. So that is where all the payment channels come in, right? Which again is what we use to do disbursements and collections, right? And we are constantly looking at different reports. For example, I think just earlier today, there's a GSMA and Microserve report from Mozambique, where they asked small businesses, merchants, what is the single most need that they would consider for their business, and 80%, both in rural and urban settings, said financing for their business. So when we see such reports out there, that is already an indicator that, we should consider such a market. So
it sounds like Mozambique.
I think so.
One for Mozambique. Manuela, you're only in one country, but where would be the second country?
I think we would go to Ethiopia, we still, it's one of the largest countries as well, like off-grid, very low electrification rate. You'd hardly have any, honestly, I'm aware of one company, one off-grid energy company who operates there, but also not at scale because it's due to the regulations in the country. It's extremely difficult, one, to move money into the country, but even more challenging to move funds out of the country. So like, again, we offer consumer financing. That means we have to raise huge amounts of capital like to do that. If you can't give your investors a guarantee of like returning any money, even if you want to. So I know that there are like talks between World Bank and other institutions to try to do something about it. Like as soon as we have that, I think we would.
Sounds like Ethiopia, but not quite yet.
Yeah.
Rafiq, you're in many markets, but what would be the next big market?
Yeah, no, so I think we already are in 7 African markets and the largest markets for bikes, but I think maybe for an 8th, probably Zambia. I think they're quite promotive in terms of, bringing financing into the country. Relatively small population-wise, but motorcycle taxis are prevalent there, and it's a little bit smaller of a market, but I think encouraging from a regulatory and incentive standpoint for financial institutions.
And it is, we think about Southern Africa as being minibus markets, and we think about the Middle Africa as being bikes. Is Zambia the tipping point? What would you say is the split between the two?
Yeah, so unfortunately, I've not done enough research on that, but it seems like it's still a little bit closer to the Eastern African side of things than the Southern, from what I've seen. Yeah.
So I think that's all we have time for. So many thanks indeed to Rafiq and to Manuela and to Geoffrey. I think if you've got a few minutes, maybe members of the audience will come and ask 1 or 2 questions if you don't have to dash, but really, really appreciate your time, your insights, and really appreciate personally learning more and more about what each of you are doing in your respective businesses.
Thank you.